My name is Garth Mackenzie and I'm the founder of Traders Corner, and I'm a technical analyst and an ETF strategist. It's certainly been a very, very interesting week on the market. Yesterday, Monday, we saw the market trade down for the biggest single-day points loss ever in history on the S&P 500, and that was accompanied by a massive spike up in the VIX to above 60. So with that in mind, we're going to take a look at what has typically happened when the VIX has spiked up in previous times. And if we go back over the past 12 years or so, the VIX has actually spiked up above 45 on 6 separate occasions, with this week being the 6th occasion. So I want to go back initially to 2008, and that's obviously the mother of all volatility spikes when the financial crisis occurred. And on that occasion, the VIX actually spiked up briefly to 90. And what I specifically want to focus on here is the fact that the VIX peaked a long time before the market actually bottomed. Sure, there was a peak, a pop up in the market after the VIX had peaked, and we saw that, but there was further selling pressure that followed in the months after the VIX had peaked. And you can see in that occasion, the market only actually bottomed in 2009 in March, and then it began to get going again. So there was a significant lesson here in the sense that the VIX did not necessarily mark the bottom of the market. The market did continue to trade lower once the VIX had spiked upwards. Now, if we go and take a look at the next chart, this is now 2010, and once again we saw the VIX spiking up above 45 in May of 2010, and you can also again notice how that followed a very aggressive sell-off on the S&P 500, but that once again did not mark the low on the market itself. In the month or two ahead of that, the market actually made a retest of the prior low, and in fact made a slightly lower low, and then only began to get going again. So once again, it was a situation where the spike and the peak in the VIX didn't actually confirm the bottom in the market. It simply enabled the first bottom to be measured, and then we saw a second bottom that followed a little while later. Let's then take a look at the next chart, which is in 2011. And here again, we see a similar setup. The VIX once again spiked up above 45 in August of 2011, and notice how that occurred with a very, very violent sell-off to the downside on the S&P 500. What followed then was a nice bounce in the market, around about a 10% bounce, very choppy action, volatility stayed elevated for some time, but then once again, the market bottomed again, made a double bottom about 2 months later, and the VIX at that stage didn't make another higher high. So once again, we saw a situation here where the market bottom actually happened only later once the VIX had spiked the first time. Let's then take another look one chart ahead, and that's now 2015. And that time you can see once again, the VIX spiked up above 45 in August of 2015. That VIX spike was then followed by quite a nice bounce in the market. Again, about a 10% rally off the low of the S&P 500. But then the low was once again retested about a month later. And at that time, when the low was retested, the VIX didn't spike up again. We got a lower VIX reading the second time round. But once again, the point is well made that the initial spike in the VIX didn't actually mark the bottom for the market that time. Then let's take a look at more recent trading action, and this is 2018. And in this case, again, you see the VIX spiked up above 45. Once again, market traded aggressively lower down to the 200-day moving average in that case. It did bounce quite violently off the 200-day moving average, about a 10% bounce that we saw after that. And then again, 2 months later only, the market retested that prior low, and the VIX didn't make a second high. Now, why I bring all of this into the discussion is because I want to have a look at how the markets have traded now recently in the beginning of 2020 in the next chart. And what you can see is the VIX has spiked up to 60 this week, and we're starting to see evidence that some bargain hunting is coming into the S&P 500 now, and we may begin to see a little bit of a bounce, perhaps even a 10% bounce to take us back up to the underside of the 200-day moving average here. But if the history of the VIX and the S&P 500 is any guide, then I would think that this rally that we see next is probably a sellable rally that ultimately results in another move to the downside in the months ahead. So that's all I've got for you this time. I'll be back with you next time with more market analysis and hopefully a look at some ETFs.